A financial storm that could hit 10 times harder than the 2008 crisis is now officially on the final countdown. I'm not fearmongering or chasing views. Industry insiders are quietly hedging their bets. The man sounding the serious alarm is not a random commentator, but a top-tier industry insider. Victor Gao, former Morgan Stanley executive, senior national interpreter, and key advisor to Saudi Aramco. Yale Law Doctor of Juridical Science, with rich experience in financial regulation at the Hong Kong SFC. Very few people truly master both global politics and economics at a deep level, and he's definitely one of the best. Over the past 6 months, he's repeated the same warning 3 times in front of global elites. Mark this timeline. Between late 2026 and the first half of 2027, the world will most likely face an unprecedented, historic financial crisis. This isn't just emotional speculation. It's a solid conclusion drawn from hard data and in-depth market analysis. Today, I'm going to fully unpack this ticking financial nuke, breaking down how 3 major threats stack up: the AI bubble, the U.S. Treasury bomb, and the commercial real estate collapse. More importantly, I'll share how regular people can get to higher ground and protect their wealth before the crisis hits. Back in January, he first warned that U.S. government debt was spiraling completely out of control. By March, he doubled down. Even without the Middle East conflict, this crisis is inevitable because the root cause runs deeper. Then in May, he officially labeled the AI bubble the core trigger and dropped the shocking number: 10 times worse than 2008. 3 serious warnings in half a year, each bleaker than the last. This is no coincidence. Either the market has lost its mind, or he's run the numbers and uncovered risks invisible to ordinary investors. Meanwhile, the moves of top-tier capital speak louder than words. Warren Buffett has hoarded nearly $400 billion in cash and refuses to deploy a single cent. Jim Rogers has nearly exited all global equity positions completely. Ray Dalio publicly stated that market risks will be extremely high over the next 2 to 3 years. But shockingly, retail investors are doing the exact opposite. U.S. semiconductor ETFs are up 89% this year, and Dell surged 33% in a single day. NVIDIA blew past a $5 trillion market cap, and retail investors are still blindly chasing AI stocks. Here's the cruel market truth. Smart money is exiting, while ordinary investors are rushing in. Does this scene feel familiar? It's exactly the same pattern as 2007, right before the crash. Back then, stocks kept hitting new highs while Goldman Sachs quietly shorted subprime mortgages. So what critical math and logic is Victor Gao seeing? If you follow this reasoning, you'll realize this is no random bad luck. The entire global financial building is failing, from foundation to rooftop. Let's start with the foundational crisis. The U.S. has borrowed so heavily that it can barely afford its annual interest payments anymore. As of May this year, U.S. federal debt topped $39 trillion. As a global financial rule, a nation's total debt should never exceed 60% of its annual GDP. That's the universal safety threshold. The U.S. current ratio? A staggering 123%, more than double the danger line. But the real killer isn't the total debt amount. It's the ballooning interest payments. Interest alone will cost $1.23 trillion this year. For the first time in history, interest expenses have surpassed U.S. military spending. Simply put, for every $4 the government collects in taxes, $1 goes straight to old debt interest. Before funding any public affairs, 1/4 of all tax revenue is already gone. Worse still, interest keeps compounding while major holders like China and Japan keep offloading U.S. treasuries. In March alone, they sold off $138.4 billion in U.S. bonds. Borrowing new money to pay old debts, rising borrowing costs, fleeing buyers. What does this remind you of? It's essentially a massive Ponzi scheme on the verge of collapse. Many people ask, America was heavily in debt in 2008, and it survived, right? Here's the critical difference most people miss. Back then, U.S. debt to GDP was only 64%. The government still had balance sheet room to borrow and bail out the market. Now it's 123%, and the government itself is the biggest debtor. To put it vividly, firefighters rush to put out a fire, only to find the fire station itself is burning. In this case, there's no way to put out the fire. Last time, the government was the buyer of last resort. This time, it can barely save itself. With a completely broken foundation, how can the entire financial system stay stable? This brings us to the core trigger of the coming crisis, the overinflated AI bubble. Let me be clear, I'm not denying AI technology itself. AI is absolutely the future. The problem is reckless capital. It crammed a 10-year industrial growth story into just 2 years of skyrocketing stock prices. Over the past 2 years, 5 tech giants poured $560 billion into AI development. But what's the actual AI revenue? A mere $35 billion. That means they spend $16 to earn just $1. Pure loss-making hype. What's worse, 95% of AI projects cannot generate consistent profits, relying entirely on capital infusion. Here's the most absurd circular hype that creates false prosperity. NVIDIA invests in AI startups, which immediately use the money to buy NVIDIA GPUs. Both sides book higher revenue on paper with gorgeous financial reports. But here's the key question. Has any real industrial profit been created? The answer is no. It's just capital circulating in a closed loop with zero real value growth. Some argue NVIDIA's 53% net profit margin is real hard profit. The numbers are true, but the underlying logic is fragile. 85% of NVIDIA's revenue comes from just 6 core clients. These firms aren't buying GPUs for immediate profits. They're buying out of fear of falling behind in the AI race. This isn't genuine market demand. It's a fear-fueled capital arms race. This arms race relies entirely on market sentiment. Once growth misses expectations, confidence collapses instantly. Once confidence shatters, the entire AI capital chain collapses. June's market crash is the perfect proof. Broadcom CEO simply said AI chip demand fell short of optimistic forecasts. That single sentence wiped out over $1 trillion in semiconductor market value and crashed Bitcoin below $60,000. It triggered $1.5 billion in crypto liquidations within 24 hours, fully exposing the bubble's fragility. Remember this, popping a super bubble never needs earth-shattering bad news. A single weaker than expected data point is more than enough. The current U.S. stock bubble is incredibly overstretched. Let's look at the data. The 7 tech giants make up over 1/3 of the S&P 500's total market value. The top 10 firms account for 40% of the market. For comparison, the 2000.com bubble peak was only 27%. Ironically, U.S. electricity consumption has barely grown in a decade. This means the real economy hasn't grown with the skyrocketing stock market. The so-called tech boom is entirely built on thin air. Overinflated tech stocks float high while the commercial real estate market crumbles below. 2026 is another critical risk node. Over $936 billion in U.S. commercial real estate loans will mature in 2026, an all-time dangerous record. Post-pandemic remote work has permanently weakened office demand. U.S. office vacancy rates hit 22.1%, a 40-year high. San Francisco's vacancy rate reaches a shocking 37.4%. Nearly 40% of office buildings sit empty with zero rental income. Yet loan payments are still due on time. Default rates have climbed past 11.8%, surpassing the 2008 crisis peak. Even Goldman Sachs is offloading bad property loans at a 15% discount. 3 major risks overlap completely: an inflating AI bubble, collapsing real estate, and a ticking U.S. debt bomb. Add Middle East tensions pushing oil prices above $120 and inflation spirals. The Fed is trapped. Cutting rates fuels inflation, while holding rates triggers defaults. It's a total dead end with no policy tools left. Victor Gao's judgment is brutally accurate. The 2000.com bubble burst left valuable infrastructure like fiber optics and routers. Amazon and Google grew strong on those foundations. But once this AI bubble bursts, there will be nothing left. Last crash left rubble for rebuilding. This one will leave absolutely nothing. Many ordinary people still think, this is just America's problem, not ours. It won't affect our lives, savings, or jobs. This is a huge misunderstanding. Let me break it down clearly. The core issue is not whether America will crash. It's that the U.S. dollar still dominates global financial pricing. China and Japan are major holders of the $39 trillion U.S. debt. U.S. debt risk is never a domestic issue. It's a global crisis. It's a global bomb that forces the whole world to pay the price. Who pays the bill? Just look at 2008. When Lehman Brothers collapsed, Wall Street traders panicked. But they still earned million-dollar salaries the next year. The ones who suffered were ordinary people. Factory workers in Detroit and restaurant servers in California. 8.8 million ordinary Americans lost their jobs and financial security. Remember this truth. Financial crises never only hurt the wealthy. Like a flood, it always submerges the most vulnerable people first. Many don't understand how this crisis will reach ordinary families. I'll sort out the complete transmission chain for you. The AI bubble pops, tech stocks crash, funds face massive redemptions, capital rushes to safe havens. Market liquidity evaporates, banks call in all loans. Enterprises can no longer borrow capital, leading to broken funding chains. The only way for companies to survive is layoffs and pay cuts. Ordinary people face shrinking income. Consumption shrinks, and global trade contracts. Exports face pressure. Factories get fewer orders. Workers lose overtime pay, bonuses, and even their jobs. Think about it. Will your mortgage, car loan, or kids' tuition fees be reduced during an economic downturn? Absolutely not. Your fixed expenses stay the same while your income drops. You think you're far from Wall Street, but no one can escape this chain reaction. This is only the first wave of impacts. The deeper harvest is yet to come. Once the system can't hold, the Fed will repeat its old trick. It will fire up the printing presses, just like it did in 2008. America saves itself by printing money, shifting the cost to the whole world. Excess U.S. dollars flood the globe and push up global inflation. Your bank balance stays the same, but your money buys far less. Simply put, America makes the mess, the world pays the price, and ordinary people get harvested. Wealthy people with hedges can protect their assets with gold and hard investments. Ordinary people with no hedges can only watch their savings depreciate. This is the cruelest rule of financial crises. Every time a bubble bursts, the elites who created it walk away unscathed. Ordinary people with no inside information always bear the losses. So who gets hit first in a crisis? Never the top elites. Buffett hoards cash. Rogers liquidates all positions. They aren't fear-mongering. They're voting with real money. You don't need to fixate on the exact 12, 18-month timeline. But all risk signals are flashing red simultaneously. Global debt hits $353 trillion, and the AI bubble surpasses the 2000 peak. Commercial real estate defaults hit record highs, and top capital goes fully defensive. All signs tell us time for ordinary people to hedge is running out. Don't argue over the exact timing of the crisis. Just remember one core truth. Financial crises never knock in advance. When the flood comes, your fate doesn't depend on how fast you run. It depends on whether you've moved to higher ground in advance or stayed in the danger zone.